Okay, so if you're a small business owner, you know the deal. Growth is everything. But to grow, you need capital. And that usually means you've got to go ask for a loan. But what happens when they say no? Let's get into the hidden story behind getting funded.
I mean, you've poured your blood, sweat, and tears into this thing. You can see what's next. Maybe it's more staff, a bigger space, or just finally having enough inventory. That vision is crystal clear in your head.
But there's this gap, right, between your vision and making it a reality. And that gap is usually filled with cash. And to get that cash, you have to convince a lender that your business is a sure thing. So what's really going on when they tell you no?
It's so frustrating, isn't it? You've got a decent credit score, you've paid your bills, but you still get denied. And you're just left there scratching your head wondering, what did I miss? Well, here's the thing. The answer isn't about what you did years ago. It's about what your business is doing right now. This is the secret. Your credit score? That's your history with debt. It's the past. But your bank statements? That's your business's diary. It's a live, day-by-day account of your financial health, showing exactly how you handle your money when no one's watching.
So what story is your diary telling? And get this, it's not some person in a back room meticulously reading every line. Lenders are now using some seriously powerful technology that can scan and analyze every single transaction in a split second.
Yep, they're using these incredible AI-powered platforms. They use something called optical character recognition, OCR, to just rip all the data from your statements instantly. And they're not just looking at your balance, they are hunting for patterns.
And this is where it gets crazy. This slide is the perfect example of the disconnect. You see a record sales month and you're popping the champagne. But the lender's algorithm? It sees a sudden spike that doesn't match the previous months and flags it as unpredictable, volatile. It sees it as a risk.
So, what are these red flags that the algorithms are just itching to find? Well, things like overdrafts or bounced payments. That's a huge one. It screams poor cash management. They also hate seeing revenue suddenly drop off or big random cash deposits with no clear source. Basically, anything that looks inconsistent is a problem.
And if you're wondering why they're so paranoid about this stuff, well, look at this number. A mind-blowing 94% of fraudulent loan applications have faked or altered bank statements. That is exactly why they rely on this tech to sniff out every little discrepancy.
Okay, so you get the no. You're feeling desperate. You need cash now. And that's when this thing, called a merchant cash advance, or MCA, starts to look really, really tempting. It feels like a lifeline, but it can be a trap.
Now, an MCA is sneaky because it's not technically a loan. They give you a pile of cash up front. In return, they reach into your bank account every single day and take a slice of your sales, plus a massive fee. It sounds easy, but the real cost is buried.
And here's the real kicker. Because they're not loans, they don't use APRs. They use something called a factor rate, which sounds harmless. But when you actually do the math and figure out the equivalent APR, it can be, and often is, over 100%, sometimes way over. It's a completely different universe from a normal loan. Just look at this breakdown. It really lays out why this is so brutal. With a regular loan, you have one predictable payment a month. You can plan for it. With an MCA, it's a daily hit, every single day. Money is just sucked out of your account, which is a constant, suffocating drain on your cash flow.
And this is how businesses die. It's called MCA stacking, and it is a total nightmare. That first MCA squeezes you so hard you can't make ends meet. So what do? You take out a second MCA to cover the payments for the first one. Now you have 2 daily payments draining your account. It's a death spiral that ends in collapse.
Okay, deep breath. It sounds bleak, I know, but here's the good news. It is not a death sentence. That no from the lender isn't the end of the story. It's just feedback. And you can absolutely use that feedback to turn things around and write a new, fundable story.
All right, so you want to turn things around? Here is your 60-day mission. For the next 2 months, this is your obsession. You're going to keep a positive balance in your account every single day. You're going to avoid overdrafts like the plague, and you're going to completely separate your business and personal accounts. These simple things tell a powerful story of stability and control.
And once you do that, once your financial diary is telling a story of stability and good decisions, suddenly the game changes completely. A whole new world of healthy funding opens up. We're talking about things like business lines of credit, government-backed SBA loans, the kind of smart capital that actually helps you build, not break your business.
It all comes down to this one simple idea, really.
Your credit score is a snapshot of your past, but your bank statements? That's the movie of your business right now. It shows what's happening today, and more importantly, it predicts what's going to happen tomorrow.
Look, at the end of the day, someone is going to read your financial story. The question is, are you going to let it be a story that just happens to you, or are you going to be the one who writes it?